and new asset classes, new fads. So um, it will delving into the world of finance. I mean, we all are going to be managers of our own funds. So we are going to play a role of a fund manager anyway. So it's better to have some kind of education and knowledge about this so that you're better equipped to handle, uh, you know, all financial ups and downs in the future. Thirdly, it'll help you avoid debt and financial pitfalls. Preparation for life uncertainties. That's a big one, because one thing is certain is that at some point we'll all be hit with some kind of financial crisis to which we'll need to respond. And lastly, being conscious of your personal finance will give you more empowerment and control. That will lead you to be less stressed, and feel more confident about your money and your financial journey. So firstly, we'll get into the building blocks of finance. We'll discuss about having an emergency corpus in place. This is the first thing that we all need to do once we start seeing money coming in, is to ensure we have 3 to 6 months of runway of our living expenses put in place. After that, we'll need to ensure that we have a life and health insurance in place. These two, point one and point two, mitigate any kind of risk that you face. And once that is done, then you can look to point three, where you can look at optimizing your investment in equity or any other asset classes. We'll also discuss basic asset allocation to ensure that one black swan event doesn't kind of wipe you off, and you have like an all-weather portfolio. And lastly, don't forget to live. That's just that it's not, everything's not always about money. So it's also about living a life, and living a good quality life. So, but all this needs to be worked out in your financial plan. Firstly, we look at inflation, because this is the number one reason why we need to invest. That's because money loses its purchasing power over time. Milton Friedman defined inflation as inflation is caused by too much money chasing after too few goods. Right? So we are coming off from a high inflation environment, especially during the COVID years, when there was a scare of unprecedented lockdowns and the world economy going in a tailspin. Then we had countries, central banks all across the world add stimulus packages and reduce interest rates so that the economies, will be flushed with money. So once there's a lot of money in the economy, the cheap loans available, there's a stress on goods and services, right? So if you are an individual and you had access to a cheap loan, you would probably take it to, consume some product or service that you have been eyeing for some time. Or if you're a business, you would utilize a cheap loan to scale your operations. And goods and services being finite, and when there's excess of demand for them, then you have the natural increase in this price of goods and services, right? So if you see India's 12-month inflation
ओए
rate,
यहाँ पे वो
in
करियो
April 21,
हाँ
it was
इसका
4.2%,
कैमरा कैसे रोटेट होगा
and it reached the high of 7.8% in April of 2022. And India's average inflation rate from
बोलियो मत
2012
ये कुछ
to
मेरा ये माइक ऑन
2023
होगा
was 6%. So the whole idea here is to ensure that our money is working for us. It's able to beat inflation in the long run, and also able to help you compound your wealth and make your corpus much better. If inflation is something that works against you as an investor, what works in your favor is the power of compounding. Compounding doesn't rely on earning big returns, merely good returns sustained uninterrupted for the longest period of time. So here the emphasis is on being consistent in your investment, in your saving, and make sure you're keeping away some money tucked away every month where it can earn you a decent interest over the long term, and this has makes a significant effect later on. Starting, it's like watching grass grow, especially if, since we all are just starting our careers, it may not seem much, but as time goes by, time being the main ingredient, it can literally, shoot off the chart, and it can result into something extremely significant, right? So um, there's one story that I always talk about, and Warren Buffett being the most celebrated investor of our time. I think there are about 2,000 books written on Warren Buffett and his investing prowess, etc. But what they do not emphasize too much on, of course, apart from his, uh, you know, performance and his skill, is the time he spent in the market, right? He's worth somewhere around uh, 84.5 billion. Out of that, 84.3 billion he made it after his 50th birthday, right? In fact, he was not even the highest performing investor. He's compounding at an incredible rate of 22%, but that still pales in comparison to someone, I think, Rob Simmons of Renaissance Technologies, who compounded at a staggering rate of about
ओए
66%, right, which is
ओए सुन
unheard of.
कुछ भी मत
But
बोलिए तेरा माइक ऑन है
Jim Simmons is worth 20 billion, whereas Warren Buffett is worth 88 billion. But the
ओए
the
बंद बंद कर
caveat
ले
here is that
बंद कर ले
Jim
तेरी आवाज आ
Simmons
रही है
started after his
तेरी
50th
आवाज आ
birthday,
रही है इधर से
right? So
इधर
he
से
didn't,
आवाज आ रही है
even though he's compounding at a much
बंद कर
faster
दे इधर
rate
से आवाज आ रही है
than Warren Buffett, he has not given that much amount of time what Warren Buffett has given, right? Um, just to emphasize further on my point, I would like to just show you all, like a basic compounding calculator. One second. Right, so we have a compound interest calculator here. So let's just work our way backward to how much we want, at a X stage in our life. So let us start with the initial sum of 1 lakh rupees. Say our monthly contribution to this was 10,000. Length and time, let's look at a reasonably good amount of time. Let's say you give yourself 10 years. The stock market has given anywhere between 15 to 25% over a decade. So let's just take 15% here and say calculate. So if you are diligently put away 10,000 rupees every month, and somewhere where you get at least a 15% return, you would have had at the end of that 28 lakhs 41,000, right? Which is quite decent for the effort you have put in. Now let us just increase it and say instead of 10, you stuck along with this plan for 15 years. Right? I'll just say 15 and I'll say calculate. So something incredible has happened here, right? In 15 years, now you have 65 lakhs 23,000. It's in dollars, but let's just say it's rupees. So first 10 years, it took you 10 years to get to 28 lakhs, and the next 5 years you got 37 lakhs, right? So your time to achieve your initial investment corpus has actually decreased by 50%, and you've also made much more money, right? So let's just increase this a little bit and say, no, let's just keep interest rate at 15. Let's increase length of time from 15 to 20. I know all of us don't think too far in the future, but this is one of the main ingredients of massive compounding is time. So let's just say calculate. So in 20 years, you would have, if you were investing 10,000 rupees per month, you would have 1 crore 40 lakhs approximately, right? So here it took you 15 years to get to 65 lakhs, and just that additional 5 years, it gave you, it doubled your money pretty much, right? So this is the importance of compounding. It's important to start early in life, and invest regularly over a long period, and this will give you the most incredible results in the long term. Right. And the thing is, right, that we all are geared towards instant gratification, right? And that's how greed sells, they say. And you probably would have seen on your YouTube, and anyone who's talking finance, etc. They're always trying to sell to our instinct for greed. But as we have a saying which says that stock market is the hardest place to make easy money, right? So on the surface of it, it always seems very easy. We have a bias where we see, one stock out of 100 stocks do really well, and we think we can double our money in no time. But finance actually doesn't work that way. And if you're investing over long term, 15% compounding is actually a very good basic, expectation to have of the market, right? So starting early is the key. Ensure you invest regularly. It doesn't matter what the amount is. It's just to have that mindset, and that you're going to invest for yourself in the future. You all must be like 20 something, right? And 20 years from now, you guys will still be fairly young and will have a lot more going on in your life and need money. So it's better to start early and be patient and have a long-term plan. Uh, Longer the time frame, higher the acceleration. So as we saw, it took 15 years to get to some 60 odd lakhs, but just sticking on give you immense acceleration in the amount you are able to make for yourself. So going back to the building blocks, we are discussing about the first one being have an emergency corpus for yourself. The idea here is to pay yourself first. That basically means to prioritize saving over other things. The way we are wired is whenever we get our income, the first thing that we set it off against is our expenses, and whatever is left behind, we look to save. But rather here, instead of income minus expense equal to saving, it should be income minus saving equal to expenses, where you prioritize your investment plan, and with whatever that is left, you work all your expenses, etc., around that. And it's extremely important to have 6 months of runway. It actually what time frame depends on you, but considering the things that can happen, you could be transitioning from a job, there could be some unexpected layoff, etc., god forbid. So if anything bad happens, at least you'll not be stressed, and you have time to get back on your feet again. So uh, extremely important to have an amount tucked away. You could put this in a saving account or a fixed deposit or any liquid funds, which is a type of mutual fund, but without any exit load, and you always have access to it. So and they all kind of beat fixed deposits. So beat inflation, sorry. So it's important to have this in place before you even think about investing your money. Once we have that in place, next thing we'll need to do is get our life insurance and medical insurance. Especially you guys being younger, I'm sure you're not really too keen about thinking of life insurance, but especially as you get older and you have more people depending on you, it's important to just mitigate that risk if something was to happen to you, and to ensure that their lifestyle still continues, right? So important to have that in place. And medical insurance, uh, medical bills is the number one killer for the middle class, right? I mean, especially if you have elderly people in the family, etc., or you're going through some kind of expensive treatment, it could literally run to tens of lakhs and have the added financial stress. So it's very important to have a comprehensive medical insurance in place so that all this risk of sudden disruption is taken care of. And I've added a screenshot here of Ditto. It is one of the companies that Zerodha has incubated. I'm not sure how many of you read a lot of finance, but they are the team behind the newsletter called FinShots. How many of you have heard of FinShots? If you could maybe just type in the comment box. All right, great, great, great. Yeah, so they have received a lot of goodwill in the market, and within the last 2-3 years, they have become among the top three insurance advisors. Primarily because they are not trying to push any financial product, but rather trying to see what is suitable to you and your needs and answering questions. So they've kind of got a lot of goodwill behind them. So if you're someone who wants to read up about insurance or talk to a medical insurance advisor, I would definitely recommend going to Ditto and arranging a call with them. So once you have these two in place, where you have like a rainy day fund for yourself tucked away, and you have life and medical insurance done, whatever surplus is coming in every month, you can look to invest. One of the most favorable asset class as is equity. And in equity, generally IPOs tend to get a lot of buzz going. They bring in a lot of newcomers into the market, and a very good way to uh, invest into a stock because there's a lot of buzz and a lot of excitement. But there needs to be a caution there because you'd at a time right now where the stock market is as close to its all-time high and there's a lot of optimism, IPOs generally tend to do very well. But when the underlying market mood is not so great, like just say a year or so back when we had Paytm and Policy Bazaar and Nykaa Zomato coming up, it destroyed a lot of investor wealth. So it's extremely important to not just take it at face value and actually go through the red herring prospectus and get to know a lot more about the company, see if they're already overvalued and how they're doing in terms of their revenue, debt, etc., and then actually invest, right? So there's no real sure shot. Uh, Another way to invest in equity would be buying and selling stocks yourself. Now, this can get a little tricky because there's always a lot of uncertainty involved with buying a stock, right? Like, for example, I've been a part of Zerodha forever, and I know how we did last year, but I cannot still predict what is going to happen next year, right? So that is me talking as an insider. So what chance does an outside investor have, right? So you'll always have to grapple with that uncertainty that you'll never know enough about what's going on in a company. So I would definitely suggest to never buy stocks flippantly based on someone's tip or what you've just heard, because that can be very deceiving. And if you're really interested in getting a stock, it's always good to do some kind of fundamental or technical analysis before you actually pull the trigger on that. If you're someone who's not very keen and who doesn't want to get into it, I would suggest you something called as small case. How many of you have heard of small case? Anyone? All right, quite a few. Great, 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 great. So small case is basically a thematic investment platform where instead of trying to figure out what stock to buy, here you select what idea you like. Here, the investing is based on ideas rather than being stock specific, right? So, like for example, this right now, we are at the small case homepage. I've just filtered all small cases here. Small case is nothing but a basket of stocks, which is based on some underlying theme, right? Like for example, you have all weather investing, which is meant to be like a ready-made, very conservative portfolio. Um, just clicking on that. So yeah, so 30% they're investing around Nifty, uh, around 40% in debt, which tend to be much safer because debt, when you're investing in debt funds, you're basically they invest in like commercial paper, treasury bills, government bonds. So it tends to be very safe, very less risky, but give you very, what do you say, just a nominal return. It'll definitely beat fixed deposit. It'll beat fixed deposit, but it will not give you the kind of growth a equity will give you in a bull market. Also, it has 30% investment in gold, these as well, ETFs, right? So it's a very conservative portfolio. So it all depends on what do you think will work. Like electric mobility is, there's a lot of buzz about it these days, and we all know that especially all automobiles, etc., are going to go through this transition from combustion engines to EVs. So maybe you think it's a good idea to invest in all these companies that who will stand to gain from electric mobility, or maybe rising rural demand, or Gen Z being very attracted to luxury goods and services. Maybe you think that these kind of brands will do well. Or with the climate consciousness, we have green energy brands are doing very well, which is 78% in 3 years is kind of phenomenal. So the idea here is, rather than figuring out what particular stock you want to buy, you rather choose a basket of stocks pertaining to an idea that you think will be profitable in the future, right? Right. So another good way to invest, a passive way of investing, would be to give your money to a fund manager via mutual funds. Mutual funds are basically where investor funds are all pulled in, and you have one fund manager who will, deploy those funds and look after it for you. So this is also extremely good way to compound your wealth, where you have a SIP on a monthly basis. And the thing about doing a SIP is you don't have the headache of monthly putting in money yourself, where that this is a commitment every single month. So mutual funds can be good that way. Few things I wanted to talk about mutual funds. One second, I'll just open up a mutual fund platform.
Mhm.
Right, so I've just opened a mutual fund platform called as Coin, and I've opened something called as Access ELSS Tax Saver Fund, because there's something that I wanted to talk about, which most people don't realize. Whenever you are looking at any mutual fund, it's very important to, of course, you're going to see what is the compound growth rate over 1 year or 2 years or 5 years. How has the fund been performing generally, etc. It's very important to keep a note of something called as expense ratio. This is basically a cost to you. Whenever you are buying mutual fund, a certain amount gets deducted and is, basically it goes to the asset management company, to pay for their operations, uh, for the upkeep of the AMC, right? There are two type of mutual funds. You have regular mutual funds and direct mutual funds. whenever you buy a mutual fund from a bank, any financial advisor, institution, etc., you're taking a regular route, which means that there's a distributor commission involved because there's a middleman involved, right? Whereas direct mutual funds, you're directly buying it from the asset management company. And this makes a lot of a difference when it comes to cost to you in the long run. As I was showing you, the Coin is basically a direct mutual fund platform. There are quite a few these days. You have Grow, you have Upstocks, all of these. Grow, I'm not too sure, but Grow for sure is a direct mutual fund platform. So expense ratio tend to be a bit nominal. Whereas if you were to buy it, from your bank or some financial advisor, there will be a distribution commission involved. Now, the same Access ELSS tax saver fund, let me just open up money control. Uh, are you able to see money control on your screen? One second. All right. I think.
Yeah, we can see now.
All right. Perfect. One second. Yeah. So this is the same fund, Access ELS's tax saver fund. If you can see, I have selected regular here. They have two radio buttons here. One is for regular and one is for direct. If you select regular, the expense ratio is 1.54%, which is literally double of what we saw where it was 0.77%. So this makes a lot of difference if you're buying into a mutual fund for a long time, because the distributor doesn't just get paid when you're entering a mutual fund. He gets paid for as long as you're vested in that mutual fund. So if you're looking in terms of decades, you could literally be losing tens of lakhs on this. So it's very important that whenever you think about mutual funds, you look at direct mutual funds, right? And also another thing I wanted to add was, of course, you have some mutual funds that do extremely well. Access ELSS fund, like for example, ELSS equity linked savings scheme. These funds, they help you save up to 45,000 in tax, and they definitely have their use in your portfolio. But generally, what I wanted to let you guys know is, say out of 10 fund managers, only about 2 or 3 fund managers will be able to beat Nifty as a benchmark over a long period of time, right? So most of them will not actually end up overperforming Nifty. So rather than trying to figure out here also, like what stock to buy, etc., what you can do is invest into like a passive index fund, right? A passive index fund. Let me just open it up again. Right, so let me just look at index fund. Let's say UTI Nifty 50 index fund. Right, so this is index fund. So index fund, what they do is they have the same uh, constituents as a normal index will have. So if it'll have the same 50 companies Nifty index is comprised of in the same weightage. So if the Nifty index moves up by 10%, your index fund will also move up by 10%. So here, rather than betting on individual stock or individual fund manager, here it's like you're betting on the country itself. You're betting on the state of the economy itself. So index fund, if you see here, the expense ratio also is at its lowest where it is 0.21%. Because it is minimal, it is very straightforward and requires very less time of any fund manager also, right? So it's, if you're looking for the safest option and the simplest, I would definitely recommend looking at index fund. You have different index funds. You have like a Nifty 50 index fund, or you could have like a mid cap index fund as well. You could look at mix and matching those to get to maximizing your returns. Let me just get back to the presentation. Right. So one of the quotes that we have hanging in our office is our favorite holding period is forever. And the reason I added here as well, I know we spoke about compounding and long term, but time in the market is greater than timing the market, right? So time in the market is greater because, we all go through business cycles. I think there have been about 27 recessions, which on average bounce back in 1.5 years. It's extremely normal to have. But the people who are the most rewarded are who are able to ride these emotional roller coasters that take place. Uh, there was a recent study done where I think if you had invested 1 lakh in say October of 2003, it would be worth about 19 lakhs today, right? Phenomenal. And say you had stayed in your investment, it would be worth 19 lakhs. Whereas say you missed the top 10 days, the just out of this entire decade, you missed the top 10 investing days, your investment amount of 1 lakh would have gone down to 9 lakhs just by missing 10 of the most profitable days in the market, right? That is a huge difference where you're actually down by 50%. And this is not just in India, even on the S&P 500. They have already done a similar research. And the thing is, out of these 10 of the best trading days, 8 of them happened when market was undergoing correction, and where people were in the impression that this is a bear market and we don't know when it's going to bounce back, right? So trying to time the market is extremely futile, and no one knows how things work out. So it's very important to be conservative. And as Warren Buffett said, the idea should be to hold for as long as possible. That is when you get the maximum amount of returns, right? Also, once we start building our portfolio, we'll need to ensure that we have basic asset allocation in place. Especially we all being much younger, you can look to be more aggressive. Uh, maybe and you could do 70% equity, 30% gold and debt funds, or depends on your risk appetite, right? And then as you get older, then you can kind of tweak it where you can make it say the opposite, where you make it 60 gold and debt and 40 equity, and slowly make your portfolio less volatile, right? So um, equity, having a good long-term plan for compounding is extremely important. You could have like 20-30% based on what you think, because it's personal finance, right? There's no real set rule, where you can invest into debt funds and you can invest into gold. For gold, I would recommend something called as a sovereign gold bond, which is issued by the government. And India being one of the leading importers of gold, and putting gold prices under a lot of pressure, the government decided to have this kind of a bond available to take some of that pressure off. The good thing about these sovereign gold bonds is that they give you 2.5% interest per year, and also you get the appreciation of gold at the end of its maturity, which is 8 years, right? So if you're looking to add gold, this could be a very good asset to look at as well, right? And of course, fixed deposits, especially when it comes to our parents and people who are senior to us, this has been their go-to when it comes to saving, etc., is fixed deposit, Dablo, right? Uh, they're not entirely wrong, because in their generation, fixed deposit gave outstanding uh, interest, right? You would get anywhere from 12 to 10% interest on fixed deposit, whereas now you kind of in that 6 to 7% zone, right? So every generation has its own bias based on what they have seen, right? Maybe the generation that saw the the 2000 e-commerce bubble, they will have some kind of bias against technology stock, for example, right? So everyone has a different opinion. So, but at the moment, you can definitely use fixed deposit to stash away cash for the short term, or for like a rainy day fund, etc. Real estate, it's a asset class that requires a lot more funds usually, and people generally get to that once they have already have had considerable amount of savings. uh, the good thing about that is it you can stay in it, you can rent it, it allows for a passive income. So definitely needs to be part of your overall plan, especially later in life, where even if you stop working, you're still you know making money and you have cash inflow. So here, just to emphasize on diversification, I have a chart here which denotes what has been the top performing asset every year. So if 2013 you had large cap outperform the market, it was a bear market that time as well. So it's right up there with 9%. 2014 you had mid cap do outstandingly well with 54%, right? So every asset class has its own day in the sun. So it's very important to be diversified for that. Even in equity, you need to ensure you have a healthy balance between large cap stock, mid cap stock, and for aggressive growth, you can look at small cap as well. And make sure you have a well-rounded uh, portfolio in equity. You can also divide it by sectors, just to give it that, in case if IT is not doing well in a particular period, you'll have maybe a pharma or banking balance it out, right? So what do you guys think is the best asset class to invest in? Uh, should it be a fixed deposit, or are you in more favor of, say, gold or fixed income asset like debt? If you can let me know in the comments, what asset class are you more inclined towards, right? Anyone wants to give it a go? Right? Nena says commodities. Vedant says equity. The thing is, when especially the market is doing well, all-time highs, everyone tends. Harsh says equity, right? We have two Harsh here, so both say equity. Uh, Rinal says commodities. Umang equity. So overwhelmingly equity, right? Um, so yeah, that's great. That's also true. So, but we never know what the future holds, right? The past is never a guarantee of the future, and we always need to be mindful of that. And one thing I always tell people is investing is not about going there and getting the most optimal result. It is actually a game of capital preservation. It's a defensive game, right? So it's very important to have a defensive strategy in place, right? And ensure not that you are not putting all your eggs in one basket, right? We laugh at the office. There's a colleague of mine called Satya, who's a techie responsible for our back office, etc. So when Yes Bank was the darling of the stock market, when it was doing extremely well, he bought 3 lakhs worth of Yes Bank shares. And from 800, there was some negative news out in the market that they have been, trying to cut corners around regulations and whatnot. So there was a immediate loss of confidence in Yes Bank, and it dropped if you're able to compound your skills, gain more knowledge, and have a broader range. I mean, that's what has worked for me. I used to be like an analyst programmer in Luxembourg, and today I'm heading sales in Zerodha. So it's completely worlds apart, and things, career especially, never moves in a linear fashion. It's always about what opportunities are present, what decisions do you take at that time, and it's very important to have a broader range. And you don't need to know um, you know a- you need to know a little bit about everything basically, right? And compounding skills and knowledge over the long time pays the highest dividend compared to any asset class. We all do stupid things but learn to identify risk. So this is what I was just telling you guys about, that investing is a defensive capital preservation game rather than trying to optimize wealth. We have so we need to be aware, constantly be aware of the consequences, know your worst case scenario, uh, place stop losses, time or money. So in stock market pale, stop loss, basically traders usually they have something called a stop loss, where if a stock goes down below a certain percentage before it can eat away more into their portfolio, they kind of cut the trade. So that is called a stop loss, right? Um, about stop loss, there's one thing that I would like to say is, um, 9 out of 10 traders, not talking about investors, 9 out of 10 traders lose money. Traders, the guys who day trade, who are constantly taking a punt and betting, right? Long-term investors generally tend to make money because they have compounding on their side. Whereas traders are fighting against time because they have to square off a position in a small amount of time. Usually they're highly leveraged as well. So 9 out of 10 of these traders lose money, but 6 to 10, 6 out of 10 of their trading decisions are correct, right? So imagine that most of their decisions are correct, but 90% of them lose money. And that is because of the way we are wired. We are very risk averse, right? If you are profitable, our emotions tend to take over, we become euphoric, we go through this whole high, and then when there's sudden volatility we get extremely anxious, and once we can't handle that anxiety, we tend to square off the position and take whatever profit we get, right? And we tend to leave a lot of money on the table. Whereas with losses, we have the exact opposite behavior. What we end up doing is, once we are into, say, a loss, say we are into minus 10, a loss is minus 10,000, we'll say, Arey yaar, let's wait on this. We start to hope against hope, basically, and we say, let's just wait, because we don't want to acknowledge a real loss, right? If you sell, you bring that loss into your bank account, right? So you say, no, no, I'll wait, let it go on. Then that minus 10,000 goes to minus 15,000, right? And now it's really starting to hurt. So now you say, anyway, I invested, forget about it. You have involuntarily decided to marry that stock, and that minus 15,000 goes to minus 20,000. It goes to a level where it like hits your pain threshold, and you can't take it anymore, and you square off, and you have minimal amount of money left with that trade, right? So that is what happens with short-term traders, is they can be doing well, make small amount of profits, but it's almost like clockwork, where you have a couple of trades that will completely work against them and bust their trade, bust their account, right? So it's extremely important to have a stop loss, especially if you're trading, and just generally in life. That's the reason I've written time or money, um, because we all can get married to ideas, married to the wrong job, and 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 lose a lot in the bargain, right? So it's important to, even Nitin, when he started Zerodha, he had given himself 3 years time to see if the business will work or not, right? So that's extremely important. And once you know the worst possible outcome, that will bring you a lot of peace and clarity into the quality of decisions you make. More on personal finance would be things to avoid: the debt trap, The consumer, our current consumer-driven world is designed to make you spend. Spending money has never been easy, right? I mean, you could have something pop up on your Instagram, some shiny new product, something that someone is selling that is apparently supposed to make your life better. Uh, so it's very easy to make you spend money, and it's important to acknowledge that all the best minds in the world are right now trying to get your attention, trying to make you spend time on the app, or trying to make you spend money. And especially with the kind of credit burden, the rising credit burden we have, it's very important to be frugal when it comes to this, especially using credit cards, etc. It doesn't feel like real money when you spend it, but you're literally paying 40% interest, right? We're talking about compounding 15% interest over a long period of time. So 40% is you're like the best asset to the bank, right? They cannot get a better asset than you. So it's very important to, even if you spend, uh, do ensure that you pay it back within the 40-day period, or whenever that high interest starts to get charged, right? And things to stay away from would be all this. With as I was telling you guys earlier, the last 3 years we had this unbelievable time where we had 120 million people join us. At the same time, to service these 120 million, to educate them, we saw a rise of influencers, like people talking about the market on YouTube. Because that's YouTube is where we go to learn stuff, right? And that gave a rise to this new class of influencers called finfluencers. And there's been a lot of, there have been some positives, exposing the younger crowd to different topics, to stocks, to investment, etc. But more than that, there's been a lot of harm where people actually use that as a tool to promise high returns, and you see these random thumbnails of how to become crorepati in 5 years with some guy holding like a big wad of cash and the thumbnail. So it's very important to take all of this with a pinch of salt. And that's one of the reason I wanted to tell you guys that stock market is the hardest place to make easy return. There's nothing called as easy return. It takes a lot of work. Even if you're a trader, you need to have exceptional strategy. You need to follow it to a T, be very stoic, and then you might succeed, right? So it's not, you might hear stories, someone who's just got lucky at the moment saying, talking like as if they found a money making, right? But over the long term, all this, you get to know in the long term, right, how many people end up losing. So very important to be conservative. And I hope, especially things like small case or index fund, etc., will put you on a track for long-term wealth creation, right? And of course, you can utilize some amount, if you have that kujli to buy one whatever stock you want, etc., do that, but not to the level where it will hurt your entire portfolio, right? So stay away from market tips. People keep asking me which is a good stock to buy, etc. I tell, because they think I'm from the stock market, so I obviously know, but I really don't, right? And I also have to open my tool. I might have some little bit of education where I can look at a technical, like a chart, with some technical tools, etc. But that's pretty much about it, right? There's no holy grail to this, and we have to be uncomfortable being uncertain, right? So take that with a pinch of salt. Stay away from unregulated funds. There's this lot of noise a couple of years ago with crypto doing well. All asset classes were on the rise, right? Once once there was a lot of liquidity in the markets, etc. Um, but because it was unregulated, when RBI regulation actually came through, it really hurt a lot of crypto investors, right? Where they have to pay a lot of tax per transaction. Also, there's a lot of instances of crypto fraud and people's crypto wallets being stolen, etc. So it's very important to invest in a regulated asset class and invest in something that you understand, right? And not because it is trending right now or is the latest fad. So, when it comes to your finance habit, this is mainly from experience. Uh, you pick the habits from people you spend the most time with, right? So if you have friends who generally take more risk, you'll end up taking more risks, right? And risk can be a good or a bad thing, but it's very important to know that you know your habits you'll pick up from them, and habits you pick early in life tend to stick with you. So that is also one of the things I was saying is start investing early, make it a habit for yourself to start now, right? We all are going to age. 20 years from now, hopefully we all will still be here, and that time you could have a phenomenal result for having this foresight, right? And third thing, habits that have paid me dividends would be prioritizing saving over other things, investing regularly, and avoiding unnecessary debt. Right. So I'm pretty much at the end of my presentation. If you want to know more about the markets, I would definitely recommend our educational portal called Varsity. Maybe I can show you guys around that as well, right? Because we've kind of tried to take away a lot of unnecessary complications, and make it like extremely simple for um, everyone to understand. One sec. Yeah. So we started this education portal somewhere around 2014. Um, it's been single-handedly written by Karthik Rangappa, and now thankfully he's hired and he has a larger team, and we are able to dish out more content. So basically, if you want to know right from the basics of the market to have an understanding of technical analysis and common patterns and indicators, you can definitely read up here, or fundamental analysis. If you're someone who's more attracted to derivative trading, you can learn about futures, option strategies, how taxation works, commodities, risk management and trading psychology. This this is actually one of my favorite, because I think um, we have incorporated a blog here, a blog post called Inner Worth, um, you know, which is absolutely brilliant. Okay, here it is, Inner Worth, Mind Over Markets, 603 chapters, right? So yeah, I mean, if you're someone who wants to delve more into finance, this would be a good spot for you to learn. We have well. Also, we have something called as varsity certification. So if you guys just want to test out, we have had 80% of IIMs, IITs do this. The passing rate has been somewhere about between 40 to 50%. So if you want to give it a shot, you can. This is an internal test what we normally give to our employees, and we've just like kind of opened it to everybody for clicks, right? So yeah, that's it from me. I hope this presentation has been somewhat useful to you guys. If you have any queries, I'd love to take it forward. Please feel free to raise your hand and ask a question. Right. Also, yeah. So Naina Kumari just raised her hand. If you can unmute and ask, please.
Good evening, sir.
Good evening.
Sir, I had to ask something about medical insurance. As you said, we should buy medical insurance, but like most of the companies offer it in their offer, like
Right.
salary plan. So do we still need to buy, or like how do we understand if it's still required or not?
Right. So that is extremely good that you have that companies give you medical insurance, but you'll need to ensure that, because you may not be there in your company forever, right? So in case there's a job loss, etc., you'll not have that medical insurance covering you then. So it's important to have a separate insurance for yourself. I don't really go on about insurance too much, because I'm sure people like Indito, etc., will be more qualified to talk about it. But it is definitely recommended to have insurance, personal insurance in place, because that way, as you get older, your premium also doesn't get too high. Right? So yes, I would definitely recommend having a group insurance at your company as well as a personal insurance to cover yourself and your family.
Okay, thank you, sir.
Great. I'll look at comments as well. Umang says, if you want to apply for an internship at Zerodha, how do we approach? At the moment, we do not have any kind of internship plan as such, especially since you guys are from IIT. I'm not, sure if you know about our CTO, whose name is Kailash Nag, Dr. Kailash Nag. So we run an extremely small team, right? And he's extremely picky that way. So we don't really do any hiring at scale. When we had that 1 million clients, we were 1,100 people. And now with 120 million clients, we're still 1,100 people. So what you can do is you can go to careers at Zerodha and you can definitely apply for whatever positions are open there. I think that would be the best. We would to be associated with Zerodha, we are coming up with like a brand ambassadorship, and that could, be one way of being more connected with Zerodha and openings at Zerodha. Once we have launched that, I'm sure, our coordinators will definitely get back to your team and let you know. Right? Any other queries, guys? Do raise your hand if you have any queries or if you want to type it out. You're welcome, Umang. Right. So yeah, I mean, that's it for me. If there are no queries, I'll not want to take any more of your time. Thanks for joining in on your weekend. It's been fun talking to you all. If you have any queries, please feel free to write to us. I've given our group email ID here, varsity.edu@zerodha.com. But you can always write to me at salman@zerodha.com as well. And I'll be more than happy to reply to you guys. So thanks a lot again. Happy weekend and talk to you guys soon. Yeah. Thank you, everyone. Bye. Thank you. Bye.